all of these baby boomers that have IRAs, they've watched 25% of their IRA vanish, and they need to retire now, next year, 5 years from now, and they're watching their retirement savings shrink and shrink and shrink, and they are worried. So now really is the time to be invested in gold and silver. So let's move on to the next chart. We've got due to positive correlation of stocks and bonds, you need a portfolio diversifier that works, gold. So explain this to us.
Well, Mike, I think it's important to say that stagflation, which was also the leitmotif of this year's In Gold We Trust report, I think that most portfolios are not prepared for stagflation at all. And the main reason is that basically no fund managers in service today, no wealth managers, private bankers, whatever, that are in service today have experienced an inflationary and much less a stagflationary environment during their investment careers. So we did some back tests, and we just had a very close look, crunching the numbers, what actually works in a stagflationary environment. Now, I think it's important to say that gold is not the solution to all our problems. It is not, it's not something that, it's not the perfect portfolio insurance in every environment. But in a stagflationary environment, in an inflationary environment, gold works really, really well as a portfolio diversifier. And this can be seen on this chart where we compare a classic balanced portfolio, which is 60% stocks and 40% investment grade bonds, to a portfolio that contains gold. Now, I can tell you, from events recently, I attended some conferences, I attended some, you've got this summer events where the big banks invite you to, and most portfolios are down between 15 and 25% year to date. And then you have to add inflation to that number. So that is an enormous amount of wealth destruction that we saw in the first 2 quarters of this year. Now, I can tell you, Mike, you've got all those asset allocation meetings coming up, and I'm absolutely certain that gold as a reliable portfolio stabilizer is being discussed at all those investment committee meetings. So I think really gold will celebrate some sort of a renaissance in traditional investing, because actually many investors will realize, well, so far this year is going horrible. We have to do something, and I think that gold will be one of the very first choices.
Yes, I believe you're absolutely correct. And another thing is that the professional portfolio managers, like back in 1971, when gold became freely traded, it was still illegal in the US to own gold. So they weren't doing it. But in Europe, it was perfectly legal to buy gold that whole time. And so gold and mining stocks and so on, they just soared in the 70s. But an average portfolio manager didn't recommend any when it was $35 an ounce or $50 an ounce or $100 or $200. They started recommending it at like $400, and then everybody was recommending it after it had peaked at $850. It was actually $873, the 1980 peak. And so then there were portfolio managers recommending it at 20% and more. There was this old comedy called Brewster's Millions with Richard Pryor. And John Candy was his friend, and he got this hotshot portfolio manager. And he goes, oh, yeah, this guy's got me in collectibles and gold. And the film was released in 82 after the peak. It was made in 82 or 83. So all these portfolio managers, the professionals, they usually chase yesterday's news. And I did a chart recently where I did several different portfolios, and one of them was the standard 60-40 bond mix, and ended up in the mid to high $100,000 invested at the beginning of this century, ended up in the mid to high $300,000 range. If you had replaced that with a 50-50 mix or even a 60-40 mix, I did both scenarios of stocks with gold instead of bonds. You came out in, it was 500 and something thousand. And if you replaced it with 50% gold and 50% stocks, it was about 550,000, something like that. And if you just bought gold, you're up at over $600,000 today, versus what all the fund managers and the professionals recommend. So I have always viewed Wall Street as wanting to sell me something that they can make a profit on. And so anyway, interesting chart. Let's continue on. Tell us about the next chart.
Well, it shows the performance, the average annualized real returns of gold, silver, and the BGMI. That's the Barron's Gold Mining Index. That's like the gold and silver stock index that is around since I think the early even the 1940s. We've got data on that, and there we show what actually works in stagflation. So as you know, we wrote about stagflation at length in this year's report. It was the leitmotif. We said, well, actually, it's stagflation 2.0, because there are many similarities between the current stagflation and the stagflation of the 1970s, but there's also some differences. So we calculated our proprietary stagflation periods. And then had a look at the performance numbers. So in the 1970s, actually, gold did tremendously well, as we all know. Silver did even better, and the mining stocks also did very, very well. For this number, it is excluding the dividends. So as you know, Mike, there were some South African stocks in the 1970s that actually had dividend yields of 15, 20, even 25%. So this comes on top. So the mining stocks were a tremendous investment in the 1970s. But if we compare it to our proprietary stagflation periods, actually, this also includes some brief periods in the 1990s and the current stagflationary periods, and then we can see that it's a different picture actually. Still, gold does well, silver does well, and the miners do very, very well. But I think it's really important to say that, well, historically, the quantitative evaluations show that gold, silver, and the miners have done a really, really good job in stagflation, not only on an absolute basis, but especially on a relative basis. So I think they're really key when it comes to stagflation-proof portfolios.
Yeah. Okay. So moving on to the next chart. The gold is a defensive and stabilizing portfolio component. So this is gold in local currencies and domestic stock indexes in those currencies, the relative performance. And this is in 2022. So this is just year to date, right?
Yes. Obviously, this is from the press conference of our In Gold We Trust report, so it has changed a little.
So it's from May of
mid-May. But still,
so what has changed though is gold is about the same, and the stocks are down even further.
Exactly. And I think in euro terms we're now up roughly 9%. In US dollar terms, we're basically flat, and in Japanese yen terms, I think what we're currently seeing in Japan, which is not really mentioned too much on the news. Gold is up 20% in Japanese yen terms. The yen versus the US dollar is making, I think, 25-year lows. And obviously the reason is the very, very aggressive printing that is going on by the Bank of Japan. Now, just to give you one number, Mike, the Bank of Japan bought 10 trillion yen in June. This is, if you adjust it for GDP, this would be like 300 billion a month for the United States. So this is really a very, very aggressive quantitative easing that they do to protect the yields from surging higher than 25 basis points. This is where they try to cap the 10-year Japanese bonds at 25 yen. And actually, there's so much pressure because the market knows that the yield should be significantly higher, and nobody wants to buy it at that price. So the Bank of Japan has to step in. And obviously, there always has to be a release valve. And in this case, it is obviously the currency, it's the Japanese yen, and therefore it's no coincidence that gold is making new all-time highs in Japanese yen terms. But you can also see that, in many other currencies, gold did its job as a reliable defender of your portfolio pretty well, and therefore I think after 2020 we all remember this very turbulent weeks during the COVID crisis when it really got going in spring. Back then, gold did a tremendous job in stabilizing your equity losses, and it did so again in 2022.
Yeah, right now I think gold is only up just a little bit from where it was at the beginning of the year, but the stock market is down hugely. Meaning, measuring gold against the stock market, you've actually made gains because if you bought gold at the beginning of the year and then sold it and bought stocks, you would get about 25% more stocks. Actually, it's more than that. About 33% more stocks, I believe, if you were buying them today with the gold that you bought at the beginning of the year. And that process isn't over with. Stocks are not done falling. And so all of the uneasiness and the worry and doubt that people are feeling, I mean, during this whole time with the stock market, it hasn't developed into a full-blown crash yet, but this is a bear market that it's in now. I have felt safe and protected during all of this. It doesn't bother me one bit because I don't have one of the things that when you were mentioning about the stock market falling and professional portfolio managers and so on, all of these baby boomers that have IRAs, they've watched 25% of their IRA vanish, and they need to retire now, next year, 5 years from now, and they're watching their retirement savings shrink and shrink and shrink, and they are worried. So now really is the time to be invested in gold and silver.
At goldsilver.com, we have a price match guarantee, free shipping, and global storage options. Get the best-selling book, Guide to Investing in Gold and Silver, for free at goldsilver.com.